welcome to the end of the chain. I'm Sam. It's another episode. This past couple of weeks have been pretty crazy, to say the least. There's been a pretty massive drop in all of crypto prices, and it came pretty quick. One of the fastest and quickest drawdowns ever. I actually filmed a podcast that day with Jesse Proudman, who is now the CEO of a company called Makara Digital. And he's been on this podcast before. Last time he was running Strix Leviathan. We had a chat about the markets, and it was interesting to get his thoughts back then. Well, now Makara is doing some amazing stuff for retail investors to become one of the first registered or SEC registered venues for automated crypto investments. It's pretty cool. I really enjoyed this podcast. He's got some cool products that I want to check out myself. I'm going to sign up and invest some money through Jesse at some point. Is definitely on the cards. I'm thinking about that. So take a listen to the episode. Also check out the website. You'll be able to see everything that Jesse is doing with Makara. And yeah, it's been a couple of crazy weeks. So in this first part of the episode, I'm going to talk about just the insanity going on in the markets. And then later we get into Makara. So I hope you like this. Make sure to reach out on Twitter or anywhere else, Telegram, if you want to find me, chat with me. If you want to get an interview as well too, just hit me up and let's hop into the episode. All right, I am joined again for the second time by Jesse Proudman, who is the CTO of Strix Leviathan. Was the CEO last time we spoke, but has done some switching around and has started a new company called Makara, which we're going to get into later in the podcast. And he's the co-founder and CEO of that. But today is March. Oh, wait, no, it's May. It's May 19th. Markets are in turmoil. It's crypto carnage today. And everything's down or was down, 30 to 40%. And it's been one of the highest volatility days that we've seen since last year on March 12th. And it's been pretty crazy, hasn't it, Jesse?
It has. I think this is an industry where you see sort of once in a lifetime black swan events multiple times a year, and we've lived the tale to tale.
So why is that? Why do we see these huge, 30 to 40% down days? Even I know we're only 12 years or 11 years into the market now for Bitcoin, but the derivatives market is huge. There's more than enough places to hedge out some of this volatility. Like, what do you think some of the reasons are behind that?
Yeah, it's an interesting question. I ultimately think it has to do with the reality that these markets have opaque fundamental value, and the valuation models that exist aren't shared amongst market participants. So the reason you believe Bitcoin's worth something and the reason I believe it's worth something are structurally different, which really makes price action driven predominantly off of fear and greed. And those are really reflexive behaviors. And so you take that characteristic and you couple it with markets that permit and encourage pretty insane levels of leverage. Like, you don't have 125x leverage in equities for a reason. And it makes for a sort of a tinderbox. We've seen this sort of play out time and time again, whether it's in sort of the smaller deleverings like we saw in April of this year, or these larger sort of market-wide events like we saw March 12th or last night.
Yeah, but it would seem that as the asset class grows, that there should be, some sort of, these sorts of days where it should just occur less often, or maybe they still are occurring. I know the volatility is the same as it was, or the median volatility is the same as it was 10 years ago, but I guess it's still pretty astounding to see the movements and kind of the price action on days like today, where it's an absolute bloodbath.
Part of it, I think, is really it's a liquidity question, and this is something we've been really fascinated with on the Strix side of the business for the last couple of years. These are it's an asset class that's measured in the trillions of dollars of market cap, but it's still one where there is pretty atrocious liquidity on even Bitcoin. On the largest asset in the asset class, liquidity can still be constrained, and particularly in events like last night, where the markets get moving in the way they were, that liquidity can dry up very, very quickly. And I think in those scenarios, it just kind of continues to accelerate the movements that begin. We've been really fascinated with that across kind of all of the assets. I think you would imagine, sort of in the top 10 by market cap, that you should have fairly deep liquidity across all of these different tokens or projects or protocols or assets, whatever you want to call them. But the reality is, sort of once you get outside of Bitcoin and Ethereum, things really, really dry up when you look at doing much depth or volume. And again, I think you combine that with leverage, and it just makes for fascinating market conditions.
But isn't that liquidity, or like the lack of it, a function of the market makers, or is it just the market participants like expecting those wide spreads?
I think it's both. I think the market makers in the space, and we've got some phenomenal market makers that exist. They do their best, but there's not sort of an unlimited number of them, and they're obviously, their primary interest is maintaining their balance sheet and their P&L, and so they're going to make decisions that are in their best interest. And if that means removing liquidity when markets get volatile, that's what it can mean. And then you combine that with market participants who can be very jumpy, and who can be really reactive or responsive, or again, kind of I go back to that notion of behavioral characteristics of fear and greed. I think those market participants can often, in the environment of in a low liquidity environment, they can cause even more damage for themselves, which is sort of a great example of what we saw last night.
I mean, but shouldn't the liquidity, or like the lack of, be on the ask side and not the bid side?
Yeah, I mean, it's a
because I mean, we've heard stories like institutions are coming, and these people are deploying, billions of dollars of capital into these markets. But like days like today, I mean, maybe they're just using volatility metrics to determine their kind of spreads that they're looking at, or using different mechanisms like a TWAP for doing these large scale spot purchases.
Yeah, I mean, I definitely think a lot of the institutions that have entered over the last 6 to 9 months, they're certainly not participating in these markets directly. I think most of them, from what we've seen, have elected to use some intermediary, whether it's Coinbase or one of these existing market maker firms, and those contracts typically have been executed, or the buys have been executed over periods of time with TWAPs. And I think those firms, they're not up at midnight or 1 a.m. or 2 a.m. East Coast time as these markets respond. I think that the reality of this is a 24/7 market. I mean, think about all of the major volatility events, and the vast majority of them that I can count off the top of my head have happened after sort of normal US hours, when these institutional folks aren't going to be sitting at their desk or thinking about this asset class. So I think that's one of the fundamental challenges. It's like, okay, if institutions are here and they are the ones that are broadly speaking bringing net new capital to the equation, but those institutions aren't playing along at after hours, sort of what does that ultimately do to that liquidity and to order books?
And do you think there's something that's added to it by this regulatory arbitrage situation, where we have these regulated, like deeply regulated onshore, or I guess domestic US players who have access to like CME futures and qualified custodians, and are bound by strict regulations, versus what's happening in the offshore space?
Yeah, I think that's a huge part of it, and it's fascinating to kind of think through the fact that these regulated institutions in the U.S. are trading the same assets sort of on the same hours as these offshore unregulated exchanges, and so there's the overlap and the impact of price action on a specific exchange on a specific asset kind of bleeding over into all these other venues. And definitely, I think one of the most fascinating things to me over the last 3 years has been watching this evolution of quote unquote institutional grade products, services, technology, et cetera. I think if we go back to the 2017, 2018 market cycle, the drumbeat in the aftermath of 2018 was that the institutions will come and that capital will sort of save this asset class. And it really took until sort of the back half of 2020 for that to actually materialize. I think that materialized on the back of a lot of this technology development, materialized on the qualified custodian landscape, off of products like the CME, off of the ability for people to deploy capital into some of these exchange traded trusts like GBTC or BlockFi's trust. All of these things have made access to this asset class easier for institutional investors and for institutional capital, but they're done in the construct of sort of 9 to 5 banker hour environments or products or offerings. Yet they share that asset and the price action with these exchanges offshore that are offering all of these incredible levered products, or are offering all of the different derivatives. And then you combine that with everything that's happening within DeFi, sort of all of the crazy products that are being developed there that are also impacting price on all these assets. It's kind of this very interesting sort of blending of exposure or access to a single asset across a very wide variety of products.
Yeah. And, a couple of examples of that would be like the CME funding rates back in April when they hit their peak. I think you were hitting 15% or maybe 13 or 15% annualized on the CME futures. But in the offshore exchanges, you saw something to the kind of like 50% annualized on the front month contract, which is crazy, right? It's just, there shouldn't really be that difference. You could arbitrage that away, but because of the regulatory landscape, it exists still. And, even with all the development, and same thing for GBTC as well too, like up until late Q4 of 2020, you still had a massive GBTC premium in their Bitcoin product, which is gone now. And I know it was trading negative for a while, but these dislocations are due to the regulators' influence of not having clear rules and structures for the crypto landscape.
Yeah, it's fascinating. I was watching another podcast a week or two ago that was talking all about kind of the cash and carry trade, and the gentleman presenting was very excited about his ability to lock in a 30% annualized return, fairly risk-free. Certainly nothing is risk-free in this asset class, but relative to spot or to levered long or short positions. And what was curious about that is sort of people look at that in this asset class and they sort of chuckle at a 30% annualized return. Like for many people, if you say you're participating in crypto and that's your objective, they'll often look at you with a puzzled face, given sort of the historical returns of the asset class. And so you combine sort of the desire of most market participants to sort of swing for the fences with the fact that to kind of properly arb those differences away, you need access to both these offshore derivatives platforms and the regulated products. It makes those sort of market structure inefficiencies exist and exist permanently. Like we're onboarded, the Strix Leviathan's onboarded as a participant with CME. I mean, it was a much more challenging process to do that than it's been to onboard with any exchange. Yet the kind of the corporate structure that we used for our onshore U.S. fund, like that fund can't go on board with these offshore derivatives exchanges because of the regulatory landscape. So you end up just with these, as you're mentioning, these structural barriers that are a function of regulation that are quite fascinating.
Yeah, and then even leaving the exchanges, I mean, now that there's a broad swath of DeFi products and like new layer ones, layer twos, and a huge new, I guess, offering of products, it's even more unanswered for the DeFi space than it is for trading for a fund on a regulated exchange or in one of these offshore platforms.
Yeah, and the biggest unknown to me there is how do events like last night, and particularly like ignore the price action, but just look at what happened to the gas fees on the Ethereum blockchain. Like just interacting with all of these contracts became extraordinarily expensive, and we've seen that at various points in time over the last year. Like, how do those events cause larger market participants who are thinking about utilizing these protocols, these technologies, it's like there's a whole additional level of risk management you need to think through that's just simply around interacting with the venues that you've elected to use from a DeFi perspective. So there's a lot of really innovative technology and products that are being developed there that come with their own unique set of risks that really are being identified and explored in real time.
I mean, what do you think? When it comes to DeFi specifically, I mean, is there any kind of regulatory guidance on this? Like, are you with Strix able to access DeFi markets in any way?
Yeah, this is an interesting one. So Strix Leviathan, as a investment manager, operates and has operated historically as an exempt reporting advisor. It's an exemption you can get with the SEC. We operate a 3C7 hedge fund, which means we take capital from qualified purchasers. And under that structure, we don't necessarily have limitations of where we can custody funds. We have elected that we will custody the bulk of capital with qualified custodians. That's part of our operational practices. In 2019 and 2020, we had looked at registering the business with the state of Washington to become a registered investment advisor in the state. And the state of Washington requires registered investment advisors use exclusively qualified custodians for client capital. And that precludes a fund or an RIA in Washington from being able to do anything on chain, because on chain smart contracts are not considered under the definition of state law to be qualified custodians. So it's this fascinating point of time where the technology and the rate of innovation that's happening here has far outstripped sort of the definitions and requirements of the regulatory landscape. And I think it's something that will continue to happen and continue to be an issue just because this space moves so quickly. We think about that on the Makara side as well. So Makara, which we'll talk about here in a moment, but we are an SEC registered investment advisor, so registered at the federal level, and legally we're required to hold capital with a qualified custodian for that product. So again, sort of Makara clients and the products that we bring to market under the Makara offering as an RIA have to be held in a qualified custodian. And the SEC also does not consider sort of smart contracts to meet that definition. So there's a lot that has to change or evolve so that sort of institutional players or asset managers have access to some of these cutting edge technologies. And it's always been fascinating to me to think through sort of that rate of innovation and how sort of I'm sure just as we get to a point where it's acceptable for us to do something on chain in that capacity, something else will have established itself that's new and innovative and different that will no longer be acceptable for us to do. So, this is an industry where sort of the individual investor has a leg up in terms of what they can access and participate in a way that traditionally it's always been the institutional investor, has maintained access. Like after hours equities trading is a great example of that. The everyday investors have access to that. Institutional investors do, but here it's flipped as a function of that regulatory landscape.
Now, what about some of the more, I guess, forward progressing states like Wyoming? Is there anything different there? Can you set up an RIA there?
Yeah, it's a good question. I've looked a bit at the Wyoming laws, and I don't know what they look like in regards to asset management. We haven't spent enough time there for me to be able to talk intelligently. I will say it's fascinating what they've been doing around the banking laws, and it's great to see a state take so much initiative and really try to build both definition, but work with sort of members of the industry to build that regulation in a way that is logical and sort of in line with what's happening in the industry. It's been really encouraging and neat to see. And places like Miami, for example, with what the mayor's been doing, trying to build Miami as a hub for technology companies, for blockchain companies. It's always encouraging when you have government regulators or government representatives who are excited with the innovation that's happening here and see that as an opportunity to build a jurisdictional advantage for the areas that they operate in. So it's great to see, and I think we're going to end up seeing more states follow suit as a function of that. Like, and the more states that follow suit, hopefully, we end up with sort of more consistent and clear regulation. Because that's part of the biggest problem here is it's not necessarily that the regulation is bad in a lot of places or cases it is, but the bigger issue is that it's just opaque, and it puts the onus on entrepreneurs in this space and on startups in this space to effectively define and write the case law for how the laws apply to the specific asset class. And that's incredibly expensive for those entrepreneurs to do. And oftentimes we end up being wrong because the interpretation that our legal teams may have as sort of startups in the entrepreneurial ecosystem and the interpretations that the legal teams at the regulators, they're going to differ. And so one of the things that I think is really neat about Wyoming is some of the work they've been doing around sort of this sandbox concept, where even if the laws are opaque and it's not clear, sort of if you're operating in this sandbox with sort of good intent, there's some room where they'll work with you to sort of help either modify the regulation or modify your business to sort of meet the regulation versus sort of immediately slapping you on the wrist. Like, those are the things that are neat to see. Acknowledgement that these laws and regulations haven't kept pace, and a desire to kind of help get them updated.
Yeah, and I think that would be better at the federal level as well too. Is that you need a sandbox to kind of be able to throw certain companies into to kind of grow and develop, and then in after a year or two, once those it'd be safe harbor disappears, then you could look at them from a more traditional regulatory aspect, especially when it comes to like young developing crypto companies and like how they're going to raise money and where do they get their initial deployment and production from what I've seen. It's kind of all over the place, and I think hopefully there's some greater clarity that is put out in the next couple of months with this administration. I will say about
it's been neat though to see. I mean, I think the SEC in 2017 was moving fairly slow to what was happening in the markets, and we saw sort of the result of that with the ICO bubble. It's been really neat to watch them over the last couple of years. I feel like they've sort of picked up the pace, and they've really done they've worked hard to provide more clarity. And again, I think it's impossible to clarify everything here, but having exhibited a desire to make this asset class approachable from a regulatory perspective, it's great, and it's encouraging to see, and it's what we need, and particularly if the United States as a nation has a desire to kind of continue to keep innovating in this asset class and to keep our competitive advantage here. You look at the largest exchanges in the world, and they're all located offshore because they played this game of regulator arbitrage, and that's been to a disservice of both U.S. investors and participants, and to be able to have those businesses sort of exist and operate here. It's unfortunate it sort of worked out that way, and I think the more we can do to be able to bring organizations or companies like that back to the U.S. would be great for the country.
Yeah, I mean, there's just some things. I mean, I know how these offshore exchanges work and the products that they're offering, and some of the products are great. It's really unfortunate that I, as an American, can't go out to, like, if I have huge, gains with cryptocurrency. Let's just say it's like something maybe in like the top 30, like top 50 or something. Like, it's gone from 50 million up to a couple of billion now, and I'm sitting on all these unrealized gains. There's no way for me to effectively hedge that. And the only way that I can effectively hedge is to use Bitcoin futures, which is pretty limited in what it is, and the futures themselves are not. So they're cash delivered, and I wouldn't be able to use my Bitcoin that's in my wallet as collateral for it. I'd have to. Actually, I don't even know how that would happen. How I could use the Bitcoin to go, I guess, go through a qualified custodian and then work with the broker dealer to be able to do that. But it just makes the hedging process a lot harder. And some of these products, which are great for portfolio management, just are not available to me.
Yeah, it's unfortunate. And have you seen? Just curious in that regard, since you do more on chain than we've done. Have you seen sort of a proliferation of products on chain that may solve some of that problem?
Like, yes and no. They're not as efficient as like a perpetual swap. somewhere. And, if they're being built on ETH, then, obviously there's limitations because it's a decentralized product, right? Obviously maybe there's not enough leverage. They're less capital efficient. They have higher fees if you're using Ethereum to open up some of these positions. And it doesn't make sense to hedge. Even, it just doesn't. It's way more simple to be able to go to somewhere like FTX or KX or Binance or somewhere and just, deposit whatever crypto you have, find their perpetual swap and then hedge out and then be, flat for however long you need it. You could go through these downturns. You're not having to worry about any unrealized losses or anything. And, maybe the funding rates are high, maybe they're crazy, but at least you're able to protect yourself in the short term. Yeah. Yeah. Cause the only other option, two options that I have are either to sell and go into, dollars, or just to, hold through it and hope that, the highs are reclaimed at some point.
Uncomfortable that can be.
Yeah, especially in days like today. Right. I talked to my friend, close friend of mine is a big Cardano holder, and Cardano went from 254 or like 240 or something like that all the way down to like $1 this morning. And he's seen like 40 or 50% of his. I think it's sitting at $1.40 now, so I think he's sitting at like 40 or 50% down from where he was a couple of days ago. And he could have hedged out at 240 or 250 and just sat in it for a while. And instead now he's down like a lot of money. Like it's really unfortunate.
This is the world that we've lived in by choosing to play in this asset class. I think it's sort of all of these challenges that we're talking about. It goes back to the component we started talking off around what is the driver of the volatility here. And I think these are great examples of that reality.
Yeah, exactly. And I think like, especially, hopefully something can get built on layer 2 or in some sort of faster DeFi or faster DeFi option to be able to hedge out. I'm sure somebody will build it at some point. It makes total sense to have these kind of financial products and to be able to offer them to people on chain. You
got to assume that Sam's trying to do something on Solana.
Yeah, of course. I think they're doing great stuff over there. I really like Solana. Maybe something happens on Matic. Maybe it's a function of the transaction fees, or I really don't know. But they're like, I think in the next like 4 to 5 years, maybe even 3 or 2, you'll see the ability to have these hedge positions, and it'll help a lot because then you'll like anybody will be able to engage in that regulatory arbitrage and access to these products.
Yep.
Yeah. So we found out today that the people buying Bitcoin at 60,000 are not actually protecting themselves against 4% inflation.
Not at this immediate point in time.
Do you buy any of the inflation narrative or hedge against wealth narrative, or like hedge against the dollar narrative, or like any of the kind of broader narratives surrounding Bitcoin?
It's an interesting question. Like, logically, I think those narratives make sense. I think having, what's so fascinating to me about this entire asset class is this notion that you can have provable digital ownership of something, and doing that in the construct that Bitcoin does it in with a fixed supply asset, like that is innovative and unique. And I think there is value in that. Gold is antiquated, and it is particularly transportable. And, there's all kinds of reasons why, as a modern investor, that may not make sense to me to include in my portfolio, but it doesn't necessarily eliminate my concerns around the dollar. One of the challenges that I have with that argument is that effectively people are, to some extent, they're rooting for the demise of the entire country to sort of prove their point right, which I think we're going to have, if that narrative pans out to be accurate, we're going to have broader problems than sort of you've stacked all your sats and you're in great shape. Like, how are you going to pay for your electricity to sign your wallet? So who's going to provide your cell service? There's it's just kind of this dystopian future that I really sort of chuckle about. But that is, going back to the sort of the use case for Bitcoin, it is a compelling use case. I don't think it's the use case that the Bitcoin was founded on. I think this notion of digital payments sort of was the driver, and we've ended up morphing sort of that that desire into the store of value argument, because that's what became more convenient with sort of what the network, how the network operates and how the capacity of the network is constrained. Uh, so yeah, I mean, again, I think at the end of the day, everybody has their own perspective on why this asset class is worth what it is to them. And I definitely think there is a large enough contingent of market participants who do believe in that inflation narrative, where it is a viable belief, but time will tell. It is, it is untested given the time frame that Bitcoin's operated in to date.
Yeah, and especially with the volatility that it's had as well too. And I think it's like difficult to separate those things and say like there's no fundamental way to go back and say that this much of Bitcoin's growth has been due to like M2 growth or inflation or anything yet.
Yep.
We just don't have those models yet. You have a growing asset class which hasn't reached maturity yet.
Yep.
And you're right. That, like, the best thing about Bitcoin is that it is the first digitally scarce asset and really nothing can take it away from that. I just think these narratives that kind of get tacked onto it, I mean, they're good for selling, right? You need to have, when people are coming to buy it, right, they've got to have an idea in their head of like why they're buying this, why they're going to buy something that's at $40,000 a Bitcoin. Like why should I even think about spending money on that? So I think
it's that what's the fundamental value? Like we get that question often. Like, what is the fundamental value of a Bitcoin? And without sort of a narrative or a story to tell, it becomes an individual by individual decision. So I very much agree with that perspective.
Yeah. So I think there is a lot there. I think it's just there's some like nuance behind it.
The funniest thing to me though is looking at now Ethereum and this EIP. I believe it's 1559. I always get these numbers mixed up in my head, but the release coming this summer that arguably makes Ethereum deflationary. If you use the argument that Bitcoin is sort of the soundest digital money because it is a fixed supply, you can also make the argument that Ethereum now becomes a harder money because of its deflationary characteristics, and you get sort of the Bitcoin maximalist crowd who will say, well, it's not actually decentralized, and look, you can see that they changed the protocol, and so therefore you can't trust it. And so there's any number of reasons you can argue that Bitcoin is a better store of value, but it's fascinating to watch these experiments play out on the scale that they're playing out at with the amount of capital sort of at play here.
Yeah. And speaking about the amount of capital, Tether had a bunch of disclosures recently. I mean, not really much. It was just a pie chart and a small spreadsheet about their current asset composition that comprises the value of, all the, $90 billion of Tether in existence, or $60 billion of Tether in existence. When you saw that, did you have to have any discussions within the fund about the potential risk that adds on of having 60% of funds in unnamed commercial paper?
Yeah, I mean, there were a couple tweets that came out. When was that? This time moves. Was it last week or is this week? Anyway, yeah. So Caitlin Long from Avanti, she had some thoughts around it, and then I think Jeff Dorman from Arca also posted some thoughts around portfolio managers needing to reevaluate risk. I mean, at Strix, we have made the decision from day one that we don't understand Tether well enough to hold it in our portfolio. That it's always been opaque. And that really it feels to us more like people trust that it's a dollar than necessarily it's been backed by a dollar. Like in our eyes, if we're going to utilize a stable coin, I need a mechanism where I can redeem or mint that stable coin at parity. I'm not going to buy or sell it like at a gain or a loss. Like I need to actually go, I can go take my money via Silvergate and mint US dollar coin at Coinbase and redeem it and do that instantly 24/7. Like I can trust that process and that structure. And we never could do that with Tether. Certainly we weren't one of the institutions that could mint or redeem it. And that's not to say that's not possible. Certainly we know a lot of market makers, other entities that have. But given that we didn't have visibility or the ability to do that, we just elected not to hold it. And I think what you'll see is that the vast majority of funds, certainly of US funds, are probably in a similar boat. I think there are plenty of other avenues, prop shops, market makers, international funds that have different perspective. And I guarantee you, anybody that's doing anything of scale with Tether has probably already had visibility that that's how sort of the composition of the basket. I think there's already visibility that that's what it was. Like, I don't think anybody doing sort of Tether at scale was necessarily surprised by that report. I think it is unfortunate. I think it's unfortunate that sort of it's been drawn out or presented drip by drip instead of the organization being more transparent upfront about the composition of the asset. But I also think, Tether have had the unfortunate side effect of being the first stablecoin and the earliest stablecoin, and like international exchanges have really had to play this regulatory arbitrage game. Plus, they've got the entire challenge of sort of the traditional banking ecosystem not having a desire to work with the organization. So, I think entrepreneurs, when faced with a challenge, they figure out a way to make the business model work. And I don't think anybody, my read is, sort of not knowing the Tether organization or its executives directly, my read is nothing here was done out of malice. I think it was done out of necessity, out of a necessity to kind of keep the business operating. There's a lot of these narratives that say Tether is a fraudulent operation and that it is used to pump the price of this asset class. I don't really buy that. I think if that were actually the case, the bear market of 2018 would likely have been much, much shorter. I think there's evidence in my eyes that that's not true, that it is a legitimate business, that it is structurally sort of accurate. I just wish there was more transparency sort of earlier on. Would have made, I think, a lot more people in the industry more comfortable.
Is there enough development on the infrastructure side from like Silvergate and from Circle to kind of overtake it at some point? Or is the regulatory arbitrage just too great between what is allowed through traditional US banking channels versus what can happen with Tether offshore?
Yeah, it's an interesting question. I think the biggest challenge that US dollar coin has, or Paxos, or sort of any of these US based stablecoins compared to Tether, it's really the trust component, and the trust component with international traders. Like most US traders, they're likely not using Tether. They're likely using dollars on dollar-backed exchanges. And most people using Tether are likely international traders on exchanges that aren't dollar-backed. And so you've got this fundamental issue where those non-dollar-backed exchanges have been using Tether since inception, and all of their market participants have grown to sort of trust that asset, and they understand it, and they believe they understand it, and they're comfortable with that risk. And so to offset that with sort of this U.S. based sort of quote unquote regulated coin that ostensibly has controls or restrictions in place above and beyond what's in place on Tether, I just don't know how you win that battle, or if you can. Time will tell. It's really, in my eyes, it's a battle of hearts and minds more than it is of infrastructure or technical superiority.
Mm-hmm. So you've taken a step back from Strix actually over the past year, haven't you? I mean, you're now CTO. How's that shift been? Like, I know you're still probably working hand in hand on a daily basis, but what's happened at Strix in the past since we last spoke?
Yeah, so Strix has just grown phenomenally over the last year and a half. So we're now, the company was founded in January of 2018. So we're 3.5 years in. The fund's first month of trading was April of 2018. So the fund now has a full 3-year track record, which in this industry is literally an eternity. Yeah, and that's like audited TPA track record. Like we're very proud of that. And over the last 3 years, just the organization has become significantly more sophisticated. So what I came to realize over 2020, like I'm an entrepreneur and a technologist, and Strix has grown into a full-fledged asset management business. And so my role as CEO over the last couple of years really has been focused on the technology platform that powers the whole organization. So we built this software stack. We call it Octopus, And there's a demo on the website, but it's basically the most comprehensive end-to-end investment management platform that we've seen for this asset class, sort of oriented towards fund managers. And so with my focus there, we've ended up growing out a pretty phenomenal team on the investment management side. I think we're up to 6 or 7 folks, sort of led by Nico, our CIO, on the quantitative research side. We've built out our investment committee with now some just incredible folks with resumes that far exceed my own. And so really it became to recognize that the company was in great hands and that there was an opportunity for me to sort of step back from that CEO seat, focus on the technology platform, and then really to use the additional time as part of this spin out that we've launched called Makara that goes live next week.
Yeah. So Makara actually sounds pretty cool. I mean, you want to go over that? Because we were talking about it before the show started, and it sounded pretty interesting what you're going to be able to offer.
Yeah, absolutely. So on the strict side, I mean, our operating thesis there, we've been running this fund for 3.5 years. As I mentioned earlier, it's a 3C7 fund. So we are limited to selling to qualified purchasers as an investment category. And a qualified purchaser is somebody with 5 million in investable assets and up. So sort of a wealthy investor today. We have phenomenal LPs. We think very highly of them, but we've been unable to work with accredited investors or retail investors. And we've always had this desire to do something that can touch a broader audience. Like, I think this asset class, we've come to recognize it's for most people, it's really unapproachable. It takes, if I go all the way back to 2017, when I started getting involved here, it was 3 full months of effectively full-time research as an entrepreneur in residence at IBM Ventures before I felt like I had a good enough lay of the land here of what was happening to begin to feel comfortable allocating or even just to understand the language. There's now, you fast forward 3 years, there's now 9,000 different assets. Like everything is named either identically to each other or it has some super foreign weird name that nobody's going to understand. And just to participate, I mean, you talk about sort of all these futures products or any of the DeFi products or any of these structured offerings, derivatives, even the spot exchanges themselves. There's a whole lexicon and terminology that new market participants need to learn to be able to effectively operate here. And we've seen this, it's been a challenge from a lot of new folks. We had a prospective LP that we were talking to, for example, who sent the wrong version of Aave. It was like Aave V1 instead of Aave V2 to their Coinbase wallet. And now it's stuck, right? It's $100,000 at the time of token that's stuck until Coinbase at some point decides they're going to recognize the token. And so nobody wants to have egg on their face. Like nobody wants to make a mistake and lose all their money. And in an asset class or an industry where that is the consequence for error, I think that's kept too many people on the sidelines. And so at the strict side, we've solved that with our fund vehicle. And we think the fund is the best way for qualified purchasers to gain exposure to the space. It's how I hold my exposure in the asset class. I'm the largest LP in the fund. But for everybody else who doesn't have access to those vehicles, we recognized that there was the industry was missing a product that could help those individuals gain exposure here. And so we spent a bunch of time working with our compliance organization last year to come up with a path where we could solve that problem. And ultimately, we concluded that effectively this industry needed its first robo-advisor, and that under the sort of the regulatory umbrella of an SEC registered investment advisor, we could launch robo-advisory for crypto that could provide sort of the simplest and fastest path for a new market participant, not somebody who's already here and sort of understands everything, but somebody who's been standing on the sidelines, is curious about this asset class and about sort of what's happening here, but is intimidated, provides an avenue for somebody like that to get exposure to the space and to do it in a way where not only were they economically gaining exposure, but they're also learning. Because at the end of the day, we think people participate here for 2 reasons. One, the returns are compelling. There's opportunity in this asset class to realize returns that are otherwise not accessible in almost anywhere else. But 2, it's fascinating, right? Just the technology, innovation, everything that's happening here, it moves so quickly and people are curious. And so if we can couple economic exposure with knowledge, being able to teach people about what they're holding, we think we're opening up this asset class to a much broader audience. And with a much broader audience, we help sort of mainstream this technology beyond where it is today.
So what are some of the products that are being offered by Makara?
So the objective here is to effectively package this asset class, not into sort of individual coins. So obviously you can go to an exchange and you can pick and choose coins to day trade, but really to package it in this concept of thematic baskets. So you can think of these like thematic ETFs that used to exist or still do exist, where sort of as a new a Makara participant, you come on platform and you answer some questions around why are you interested in this asset class to begin with. And for some people, like we spoke about earlier, it could be that they're most concerned about inflation. Some people could really be interested in what's happening in the decentralized finance world, like this notion of replacing sort of traditional banks and financial intermediaries with technology. We've seen a lot of interest in that sort of sector of the asset class. Some people could say, look, the whole thing's just curious to me, and I just want, like, what's the Russell 2000 equivalent? How do I get access to as much as I can without having to figure out sort of how to construct a portfolio that does that? So these thematic baskets sort of are designed to sort of fill an interest or a curiosity sort of for each one of those particular questions. So at launch, we'll have, I believe, 6 baskets. And there will be just a Bitcoin basket and an Ethereum basket, single assets, since those are the 2 largest coins. And a lot of folks are interested in those for their specific reasons. There will be what we call the universe basket, which is that Russell 2000 equivalent. It's a basket that holds every asset available on platform, but it's risk weighted instead of sort of market cap or equal weighted. There's a decentralized finance basket. There is a blue chips basket, so sort of the large liquid projects. And then there is an inflation hedge basket, which is tokenized gold and Bitcoin sort of 50-50 mixed. So they're effectively index funds or the equivalent of index funds. They're sort of, you're not purchasing, it's not a pooled investment vehicle. When you subscribe to a basket, behind the scenes, Makara is purchasing the underlying assets and holding them at a qualified custodian for you. So if you buy the inflation hedge basket, you're actually holding Bitcoin in an account that's titled to you, and you're holding Paxos Gold in an account titled to you. So you're actually participating in the networks. And so it's really, again, it's about how do we simplify this access and exposure in a way that makes, we just want to make it easy.
So why would somebody buy Bitcoin through Makara versus just buying it spot on like Coinbase or somewhere else?
Yeah, it's a good question. I mean, we think that Bitcoin for most people sort of acts as the starting curiosity point, and the thesis here is that buying it through us, like if you go to Coinbase and you go buy Bitcoin, you're paying, depending on sort of which Coinbase property you go use, you're paying 50 to 4.5% in fees. The Makara offering as a qualified custodian or as a RIA using a qualified custodian, we're not legally allowed to charge transaction fees, and we're able to aggregate all of our volume with our trading partners so that the actual execution costs sort of on exchange are a fraction of what an individual retail investor would pay. So we can get our clients arguably better execution or with less fee than they would get being able to go directly. And then they get to sort of broader access to the entire platform. So certainly if somebody is comfortable with an exchange and they understand buying Bitcoin and like that's all they want, I think there's plenty of venues where they can go do that. But for somebody that's just getting started and is really trying to figure everything out, we think this is it's about ease. It's about ease and simplicity to get aboard.
And what about the other products? I mean, you talked about one of the baskets being risk weighted versus market cap weighted. Like, why would you do that, and how are you doing the risk weighting?
Yeah, so we've built. I mean, this is one of the advantages. So Makara, again, it's a spin out of Strix, and we are licensing the Octopus platform fund Strix to use to run these baskets. And so the benefit of that is that Makara gets all of the technology, gets all the advantages of the technology we've developed over the last 3.5 years to be able to utilize in its investment products and the composition of those products. So the risk weighting mechanism, this is an algorithm that we wrote on the Strix side, and it effectively is trying to balance a portfolio composition in a way that sort of each asset has a equal amount of impact to the portfolio's aggregate performance. So you sort of de-weight more volatile assets and increase the weight of less volatile assets. And particularly given sort of a basket like that, which I believe has about 42 or 45 assets, like you don't necessarily want to equal weight all of those assets, and you don't necessarily want to market cap weight all of those assets, because equal weight sort of you'll end up with, in our eyes, an offering that may be too volatile given sort of heavier weighting to smaller cap offerings. And market cap weighted, you'll end up with not enough allocation to those smaller projects. They don't actually have much of a material impact. But this allows us to create sort of a structure that otherwise would be pretty difficult for an individual investor to go and do on their own, like to go figure out all these weightings, to go then buy all 42 assets, and then on a quarterly basis to sort of rebalance back to targets. Like, that's not practical for everyday folks. It's certainly, sophisticated market participants can go and do that, but we're thinking this is a product for somebody that's working 40 or 50 hours a week in their job, and they come home and they want to spend their nights and their weekends with their family, and they don't want to sit in front of their computer all day executing dozens and dozens of trades in an ecosystem and an environment that moves at just alarming velocity. We want to be able to solve that problem for somebody in a way where they feel like they've got appropriate exposure for their interests and for their really for their interest and their desire to participate in this space, and without having to invest all of their time. Like, time is the most valuable thing, and you shouldn't be spending it sort of day trading this asset class if that's not your passion.
Yeah. And how's the performance of that basket been?
Yeah, so they're all, given the performance of the broader asset class over the last 2.5 years, this is one of the challenges here, is that we're sort of on the tail end of an incredibly compelling return history over the last year and a half. And sort of, but we all know that historical returns don't necessarily have bearing on future performance. So it's hard to say. Sort of each basket and the way you present it within the interface gives the user some sense of performance characteristics in different market conditions. Given that most of these assets are relatively new, we don't you can't go back and necessarily construct these baskets from assets that existed in 2018. So that's a challenge for market participants in this industry today. But we're happy. I think at the end of the day, the performance of these, each basket is unique and has its own characteristics. And the biggest challenge in all of this, you go to traditional robo-advisory, and their objective really is to identify your risk tolerance and to deploy you into a variety of assets that match or meet that risk tolerance. At crypto, we have risky, riskier, and riskiest. Like, everything is really correlated, and it's hard to argue that any one thing has a different risk profile than another. Certainly, we can use some metrics on our side to be able to differentiate that. But at the end of the day, we believe it's a more important question around sort of why are you here and what are you interested in than it is around raw performance numbers.
Yeah. No, I can understand that. And what about the fees for entering into some of these baskets?
Yep. So the fee structure. So at launch, anybody on waitlist at launch gets 6 months of fees waived. The eventual fee structure, it's just a blanket annual management fee of 1% across all of the assets in the portfolio. And that includes sort of everything that we need to operate. So we're handling, again, all of the custody of the assets. We're handling all of the trading. Certainly the user does pay trade execution fees at the venue, but they're benefiting from our aggregated volume, and that's not a fee paid to us. And we're handling sort of all of the reporting that a user would need. So it's really, again, we're trying to make this simple and transparent. I think one of the big factors for us in the last 3.5 years at Strix was that we believed this asset class by far and large was too opaque, and particularly that most funds weren't transparent in their reporting or in their return attribution. And we've really spent a lot of energy as an organization ensuring that we can be as transparent as possible. And we've wanted to carry that forward as we spun out Makara. So sort of simple in our eyes is better.
Yeah, I can understand that it is pretty simple, and especially for some of these, like some of the more complex products that you were talking about, where the rebalancing, the custody prices, that does add on, some fees that do need to be added into that, especially for the safety and security of having it with a qualified custodian as well too. Are these products able to be put into an IRA or something else?
Yeah, absolutely. That's a neat component to it. So we've been working with a company called Alto IRA. for the last year or so on the Strix side of the business. And that sort of that partnership allows us to take clients and have them roll over IRAs into these self-directed vehicles that Alto provides, and then use those self-directed vehicles on top of the Makara platform. So I think it's been a phenomenal product, and certainly in an asset class where the return stream has been sort of where it's been historically here, it's logical to use sort of tax advantaged capital to deploy here.
Yeah. And what about like sizing? Like, do I need to be like buying with size to be able to access these products?
No, that's the neat thing. So because of this licensing and how everything is structured, effectively there is no minimum. I mean, I think like as a function of just the way ACH works, the final equivalent will be like a $50 funding restriction. But you don't have to put $5,000 as a minimum, or 50 or 100,000. All funds, all institutional funds have some kind of floor that's really driven as a function of their regulatory structure and a limitation on the number of investors they can have in the vehicle. And so that may mean, some funds will tell you it's a $500,000 minimum to participate, but we don't have that with the licensing that we have on the Makara offering. So we want to make this accessible. And, there's a lot of people that again, they're just curious. And so, they're not going to go put a significant sum of money. They may just put $50 and they want to learn from that. And that's great. We want to be a venue for those folks just as much as the folks that want to go deploy hundreds of thousands of dollars.
Mm-hmm. What are some of the future products that you guys are going to have for it?
Yeah. So so at launch, the baskets will primarily be these index structures that I referenced, and sort of they're not just sort of simple to reconstruct indexes. I think that there's a bunch of thought that's gone into them, but they are passive vehicles. And so you ride the ups and you ride the downs. As time goes on, we're going to add what we consider or title actively managed baskets. And so because of the partnership with Strix, and because of that Octopus trading platform, we have the ability to run algorithms or to systematically trade these baskets and to construct vehicles that may be more sophisticated than what an individual trader may do. So an example of that is a structure we have called the Momentum Basket. The Momentum Basket is a Bitcoin Ethereum relative value trade that's looking at the forward expected return of Bitcoin and Ethereum, and will reweight the portfolio heavier Bitcoin, heavier Ethereum, or into a partial cash position based on its perception of what's happening in the markets. And so it's certainly, there's no guarantee of performance in any of these vehicles, but it's a nice, interesting way, given sort of that Bitcoin and Ethereum have historically sort of decoupled their larger movements. Obviously, Q4 of last year was a big, Bitcoin benefited in a big way in Q4, and Ethereum has obviously done very well lately. And so if you have the ability to sort of reweight as those movements occur, we think that can create a compelling return stream. We're also looking at opportunities to sort of emulate a defensive crypto basket. So one that is not necessarily targeting maximum gain, but would be targeting sort of limited drawdown. So instead of riding these 40, 50% drawdowns, or the 80% drawdown of 2018, limiting that to a much smaller number. So you won't see sort of eye-popping returns like you do in these broader markets in a construct like that, but you also won't have to stomach the same level of downside that you do in passive vehicles.
That's pretty cool. So where can people go and find this?
Yeah, absolutely. So Makara, we're launching Tuesday. You can find us at Makara, Makara digital, digital.com. The release will be waitlisted, so we'll be taking initial users off the waitlist beginning on Tuesday, and hopefully we'll work through that waitlist pretty quickly.
This is pretty cool. I'm probably going to have to put some money here. I can share this with my friends as well too. This will be good for them.
I mean, that's the neat thing, right? It's like everybody who's been in this space for for any amount of time, particularly over the last couple of weeks, we've all been receiving text messages from folks who are basically saying, "How do I get involved?" or "Should I buy dog money?" Like, and so being able to just say, like, "Look, here's a simple, easy place to go that gets you exposure to the space." Like, at the end of the day, I don't think many people want to act as financial advisor to their friends. It's not a rewarding proposition. So being able to direct them to something that can help guide them, I think, has a lot of benefit. Like we wanted to build the thing we've wanted to hand on to all of our friends.
Yeah, that's awesome. Jesse, where else can people find you?
Yeah, absolutely. So Strix, if you want to learn about that business, you can look up Strix at Strix Fund, StrixFund. .com. And then I am on Twitter at Jesse, Jesse, Proudman, Proudman.
Well, that's awesome. Jesse, thanks for coming on. And I'm going to be super interested in seeing how Makara comes out. I'm going to have to sign up and put some money in once it
We're
launches.
pretty excited. Yeah, it's going to be a big week for us next week.
Awesome. Thank you, Jesse.
Have a great one.